Hello, it's Darcy Hardy and Keith Pitsch. We're back for our second month of
round two
of real estate experts, putting the real back in real estate.
Nice. I love the live canned audience. Live canned audience is great.
You know, it's nice to have people in person again. So what's been going on in your life?
Not much. No? Not much. I think we do have to give full disclosure, right? This is our second show this month. This version is not live. Unfortunately, I will be out of town when this goes live. So Tuesday coming right at you. I'm glad you guys are here. I'm glad you guys are supporting us here Tuesday at 2 p.m. But just know this, next month, we're back in studio and it will be live. So all those interactions on Facebook and Instagram and all those other live outlets, we're looking forward to them. But I'll be on vacation.
Yeah, so somebody might have forgot he had a vacation coming up. Just saying.
Yeah, but it's great. I'm having a good time. The seasons have definitely changed over the last month.
Yep.
All the leaves are falling out of the trees. It's been very nice to put the kids to work with a rake in hand and here you go. So so just changing the seasons and now getting all the Christmas stuff out.
The real estate season has not really changed much though.
No,
like how I did that right there.
Yeah, I did. What's new with you though? Before we jump into real estate, tell us what's new with Darcy.
All is good. We also have a vacation coming up right after yours, and celebrating a 10th birthday of the kiddo. Woo-hoo. So Disney, here we come.
Not just Disney, you're gonna crush
Legoland too, and California Adventure, and it's actually very exciting because my husband has never been to Disney either. So
no way, JT's never been to Disney.
He's never been there. I went to Disney World once when I was 6. So it really will be a family adventure. We're excited.
Wait, you said either. That means you haven't been there.
I did go 2 years ago for 4 hours to California Adventure. So technically I've been there. But I went to Disney World when I was 6. But that's all.
There's probably a story around that 4-hour trip, but maybe that's for a different podcast.
Yeah, that's a different podcast. Super excited about that though. So that's it. I guess November is the month of vacations, and we're excited about it.
Why not? Why not? Right? So,
yeah.
Well, shall we turn that page into the real estate world and jump into it?
Let's do that. We're going to talk about money today.
Money. I love money. Money's good. Money helps you do things.
It does. So. Money's fun. I like money. But let's rate the rates first.
Rate the rates. Boy, howdy. So when this airs, we're going to be exactly 7 days to when the Fed announced that they're tapering their purchases of treasuries and mortgage-backed securities.
Okay, so
Darcy,
go ahead.
You want to take a stab at this?
No, you go ahead and explain exactly what that means, Keith.
What does that mean? So think about it this way. To me, really simple layman's terms, that means rates are going to go up.
Yeah.
And here's why I say that. So they're saying they're going to, look, I'm not so worried about the treasury side. Let's talk about the mortgage-backed security side, that right now they're going to taper $5 billion worth of mortgage-backed securities that they have been purchasing throughout the whole COVID time. So what that means is the mortgage industry is going along, and they're doing all these loans, and then they're selling them into the secondary market, the mortgage-backed security market. And right now, the Federal Reserve has been standing at the window as their number one buyer. Like, hey, I'm here to buy those mortgage-backed securities. I love them. And so they're going to take $5 billion worth of capacity, of buyer capacity, off the table. So that buyer capacity now has to be filled by other private funding groups, right? So other REITs, other hedge funds that want to buy mortgage-backed securities. So what that will have is a very fundamental impact on rates going up.
Yes. Simply speaking, the investors want more money out of it, right?
Yeah. Well, the investors like, hey, I'm crushing it over here doing 9-10% rate of return. And and you're going to sell me a 30-year fixed at 3%? No, I'm good. I'll pass. So long story short, it will put upward pressure on rates. They will trend up over the winter months. And the Fed was very cautious that said, hey, look, we get it. We get it. If the economic engine starts to seize and we see signals that we need to get back in the pool, they're going to jump back in the pool and everything will go back to pre-taper environment, right? So we'll see how that all plays out. I think you can definitely expect over the next 2-3 months that we see a increasing rate environment and then a leveling off, I think, there towards the new year. But the future will tell where we're going. But, you know, we definitely saw it today. Today, when we're recording, is Wednesday. And we saw the market move pretty substantially after the announcement this afternoon.
An increase in rates at this time of year in the last few years hasn't been that odd, correct?
No, actually, right here in November, rates tick up a little bit, and then they kind of fall off the cliff in December, January, and February. So we'll see if that trend stays moving forward. I don't think so. I think we're going to jump up and taper off.
And we need to reiterate, we're talking about rates going up, but in the big scheme of things, it's that much.
Rates are great.
Yeah.
Rates are awesome. So, I mean, so, you know, 3% is still killer awesome money.
Yep.
You know, if your cost of funds is in the threes and you really need to think long and hard talking about money, liquidating assets that are performing in the market, that are performing 15, 17, 20% annual yield. So you're making a rate of return of 20%, and you want to go liquidate that asset to go leverage a house and get a smaller mortgage at 3%.
No.
Think about that.
Yep.
Yeah.
And a lot of people don't think about that in advance until you put it in those terms. So that's a great way to look at it. See what you can make with your money somewhere else.
Arbitrage.
Yep. Arbitrage. Great term.
That's a whole nother show. We'll bring that to another podcast, but arbitrage is just powerful stuff. And we're not taught that in the school system.
No. Well, maybe you weren't.
No. You were taught arbitrage in the school system?
But that was a whole nother story too. On the last episode, we said we'd talk about earnest money a little bit. So I want to dig into earnest money because a lot of people talk about the definition of earnest money, which is money that you're putting down as the buyer right after you get into contract in order to have the sellers take the house off the market and hold the house for you until you close. Okay. Now, in this state, all we do is earnest money. There's a few other states out there that do things like option periods, and you have to pay for that too. We don't do any of that here, so don't get confused. All right. Earnest money, the thing is...
And here being Washington State.
Here being Washington State. That's very true.
Yeah.
The thing about earnest money, though, is if you get out of the contract as the buyer for a reason that is allowable in the contract, you get your earnest money back. Awesome.
Yay.
If you leave the contract because of a reason that's not in the contract, you run the risk of losing that earnest money.
Why would I do that, Darcy?
Yeah, I know. Okay, so reasons.
I'm leading the witness.
Yeah.
I'm leading the witness.
I want to give you some actual real life examples of how people have lost their earnest money, things that I've seen or either, well, no, not all my clients, but things that I've seen in the market before. So one person that I know, she had a bad dream 2 days before closing. And the bad dream included something about her family dying in the house or something along those lines. So they backed out.
Oh, dang.
Yeah. They backed out of the deal and they lost their earnest money. Okay.
Wow. That's like the Sixth Sense kind of thing.
Yeah, it really is. Would it have happened or not? I don't know. But they lost it.
It won't now because they didn't buy the house.
Right. Exactly.
Problem solved.
I did have a friend who had a contract, and that buyer got out of the contract because her psychic told her to get out of the contract. You know, we all judged that, but the rest of the story was last time her psychic told her not to buy a house, and she didn't. The house caught on fire the week after it was it would have closed. So maybe the psychic knows what they're talking about. I don't know.
Whoa.
But so those are reasons if you are in the contract and don't specifically write in like bad dreams or psychic, which nobody would, you run a serious risk of losing your earnest money.
You got to warn me when you're going to do that. I was right mid-drink.
Okay.
I don't think I've ever seen that written into a contract,
No,
Darcy.
I haven't either. I've never written it into a contract either. Now,
If I have a bad dream.
yeah.
Okay.
Yeah, but it's a great example. Now, reasons why you would get your earnest money back are things like the inspection period. If you decide to leave the contract in Washington State.
Can I time out really quick?
Yeah.
Like another more like run-of-the-mill illustration would be like I've had somebody that got transferred jobs-wise.
Lost their job.
So just to kind of bring it into a different context, I had somebody that was here, and then all of a sudden they said, Keith, I just got transferred to this other place. What am I supposed to do with this? You know, they still technically qualified for the loan. They still were under contract. They just couldn't do it because they're relocating. In that case, the seller was not so nice. They could have been gracious and let them out of the contract given the situation, but technically they didn't have to.
Right.
So, but yeah. So anyway, continue.
So
you
those
were
are
saying
great examples of ways that you could lose your money, earnest money. Okay, let's give some examples of ways that you can get your earnest money back. Now remember, it has to be something that's in the contract already that allows you to get that earnest money back. So if you have an inspection period in Washington State, if you leave the contract for any reason during the inspection period, even if it's a bad dream, you can get your earnest money back. Now, I'm sure, Keith, you've seen somebody lose their job before.
Yeah, a handful of times, especially during COVID.
Yeah.
That was not fun.
It was not fun. And if you lose your job and you still have what we call a finance contingency in the contract, then you can get your earnest money back because of that. But you got to be careful there. Because if you don't have that finance contingency in there, then you would run the risk of losing your earnest money. So you have to be really, really smart about how you write the contract. And that's when you need to have an agent that understands the financial situation, works well with the lender, and is able to guide you through exactly the right reasons why you would and you wouldn't get your earnest money back.
So in full disclosure then, like there's been people in this most recent market that have gone out there, and what you're referring to, correct me if I'm wrong, Darcy, are contingencies, right? Yep. Contingencies in the purchase and sale. So there's been people out there that are waiving all of their contingencies. What recourse do they have?
Yeah, so I have one right now. We got into contract yesterday. Super excited for them. They have to put down earnest money because that is one of the things that you have to do in order for it to be considered a contract here. And right now, earnest money is actually a large amount, but that's dependent upon the market. Also, right now, because it's a massive seller's market, people are releasing their earnest money as soon as they get into contract, saying, hey, escrow, please give the seller my earnest money now. The seller doesn't have to wait until we close. And that's a extra incentive for the seller to choose the buyer, which can be a great thing to do. However, if the buyer leaves for any reason whatsoever, gets out of the contract for any reason whatsoever, that money's already gone. Okay, there's no recourse.
Now, can we take a breath here and just talk about this really quick?
Yeah, let's do it.
Because I'm sure there's people watching right now and saying, "Oh my gosh, no contingencies, releasing all my earnest money. That is crazy."
Yeah.
And terminology, words are important, right? Words are important. It's something that I think buyers right now in a buyer's mentality needs to come to understand how the market is working. And
yes,
that sounds crazy. you may not be ready to buy your house right now and go to the market in a position that you can find yourself winning. So I want to talk to that, because there's a lot of people out there coming to the market and they get really frustrated because, Darcy, you've seen them, we've talked about them, that they come into the market that's like just white hot and like, I'm going to have a title contingency, an inspection contingency, a Friday contingency. I made that one up. And all the contingencies I want in my offer.
Right.
Right.
So, yeah, people need to really analyze. I know you want to protect your money. You want to protect, be conservative, and everybody has a different threshold for risk. Right. And I respect that. But now look at it from the seller side.
Right.
If you are the seller and you have the option of less money, many ways that the buyer can get out of the contract, or more money and the buyer cannot get out of the contract without losing money, which one
Let's
are
call
you
it
going to
same
go with?
money. Same money. And buyer can't get out of the contract.
Yeah.
Right? It don't need to be more. I just need to know that the buyer's going to be in it to win it.
The terms of the contract in this market are super huge. It's not just the dollar value. It's the terms that are really, really big deal. Dollar value doesn't hurt, but are you going to pick somebody that has a whole bunch of outs in the contract, or somebody who's stuck in the contract? Different people
stuck in the contract.
You know, it's funny because some people are very much like, oh, let's go with this one. We're guaranteed to get the money. And every now and then you have a client that says, you know what? These people are the underdogs. Let's give them a shot. And they choose the other deal. And I'm telling you, it always goes bad. I appreciate
the underdog deal always goes bad?
The underdog deal, it always goes bad. The seller's always like, what were we thinking?
Yeah, note to seller. Mm-hmm. Don't do that.
Yeah, don't do it. It's just funny how that has worked out in my experience there. But, you know, when you're getting into the market, I know you want to protect yourself. And in certain markets, you can really do that as the buyer. This is a really hard one to do that with. So you need to have a very serious conversation with your agent about the realities of the market and listen to them. And you're always going to hear stories of, oh, well, I got this at this much under price. And yeah, the people that are telling you these amazing deals that they got are usually not in this market or this area. So you have to temper that a little bit.
Yeah, real estate is local. So let's put a little more meat on the bone if we can.
Yep.
Darcy, typically, when is this earnest money coming out? Let's pretend I'm the buyer. I'm buyer Keith. Hi, my name's buyer Keith.
Right.
When do I have to write this check for this earnest money deposit?
Well, there's a few different ways that you can do that. It doesn't have to be a check. It can be a wire. Oh. Okay, so if you got into contract yesterday.
Okay.
In the contract itself, it now specifically states how many days it is until that earnest money is due. Common practice is people say 2 business days. So if you got into earnest money, if you got into contract yesterday, your earnest money would be due by close of business to escrow tomorrow. 2 business days.
2 business
one today,
days. So that doesn't include Saturday and Sunday or holidays.
No weekends, no holidays. 2 business days. And it has to be...
Is the day after Thanksgiving, this is always a trick question, is the day after Thanksgiving considered a holiday?
I haven't looked at it.
I don't know.
I don't know for this year.
Are we funding the day after Thanksgiving?
I don't think so.
I don't think we are. Let me check with the funding
banks are
department.
Closed, right?
Nope, we're not.
Yeah, it's always that way. So there are times that 2 days can literally be 2 days, and there's times that 2 days can be like 6 days. So you have to be very, very careful.
Is this like Common Core math? How is 2 6?
Right. So let's look at you get into contract on the Tuesday of Thanksgiving week. Okay.
Ooh.
Wednesday is day 1.
Gotcha.
Thursday and Friday are holidays.
I'm eating way too much food.
Right. Saturday and Sunday's weekend.
That's 7 days.
I thought Tuesday, Wednesday, Thursday, Friday, Saturday, Sunday. Yeah, Monday is when the earnest money would be due. So you really have to pay attention. It's kind of crazy. And your agent should be able to help you. Oh, by the way, in our state, they're called brokers, not agents. We're all brokers. Just to confuse things further.
We've been doing it wrong all this time?
Yeah. But that's okay. That's a whole nother ball of wax. Okay, so that is...
Broker Darcy.
Yeah, right?
That's going to be the running joke for this show. Joined by Broker Darcy Hardy.
I'm not just a broker. I'm a managing broker.
Ooh. MB.
We'll get into all that at another time.
That's pretty cool. So 2 business days, you got to drop that money in the pot.
Yeah. So let's talk about the ways that you can give that money. Okay. So number 1, the money is due to the escrow that you're working with defined by the contract. Okay. You can wire the money to escrow, and simple escrow gives the buyer the wire instructions. You want to be very careful with that because there's a lot of wire fraud right now. People trying to trick other people out of the money. So it's not the most secure way to go. Number 2, you can go down to the bank and get a cashier's check and either drop that cashier's check off at the escrow department or have a courier come get it. Number 3, you can write a personal check and drop it off or have the courier come get it. And number 4, something that a lot of escrow companies are starting to do is there are some apps out there these days that you can deposit earnest money with these special apps. And it's really cool. Just like online banking, you take a picture of the front, you take a picture of the back of the check, and lo and behold, it uploads it to escrow and your earnest money is deposited. And that is my favorite way.
Wow. That's cool.
Now, notice all of those ways you needed the money in your account. Right?
Yes.
So let's talk about source of funds, which I know is a huge deal in the lending world. And
it's one of my favorite topics.
It becomes a huge world in the broker side of things too. Okay, so different types of sources of funds. This money, if it's in the checking account, we good, Keith?
Yes, checking account is good so long as it's been in the checking account for 60 days.
Ooh. What if they sold stock like 15 days ago?
Yeah.
And now it's in the checking account.
We're going down the rabbit hole, you guys, and I just want to prepare you for this. This is what drives buyers insane.
Yep.
And what I mean by that is all of a sudden, we're in the middle of a transaction, right? I have plenty of money for the down payment. Let's call the down payment and closing costs. Let's call all that $100,000. Yeah. I need $100,000. I've got a little bit over here in the stock account. I got a little bit over here in my money market account. I've got a little bit down here in my bank account or my checking account. And then I've got a CD over here. And then all of a sudden you start pulling all these funds apart. And this is where Darcy's going. Well, you got to document it all.
Yeah.
And I feel bad for my clients sometimes because they start moving all this money around, and then all of a sudden we're asking for an updated transaction history. And Darcy, if I got paid for every time I said, hey, could you provide me with an updated transaction history? I wouldn't have to do mortgages. Long story short, folks, this is where the pre-approval process is so important, to cross the T and dot the I of assets to know where they're coming from. So if that money, to answer Darcy's question, I totally went off on the rail there. To answer Darcy's question, if you sold stock and dumped the money and the proceeds of the stock sale into your checking account, I need to see the stock account for 2 months, and then I need to see the transfer from stock into your checking account, and then from your checking account to escrow.
And I think people really do understand when a lender asks for that. I'm going to add one more thing on top of this. As the broker, I need to know before we write the contract that that's what you're doing. Because the proper way to write the contract is for me to define if the money is coming from some source other than your checking or savings account. So if you have to sell stock, I have to write in there certain amount will be coming from the sale of stock. You can adjust it and everything, but to have the contract done right, we need to know that.
Well, and to take this one step further, money is super important, because if you're selling that stock and you're selling that stock to put down the previously mentioned earnest money, it takes time to liquidate stock and get it into your account. It may be longer than 2 business days.
So
and that could put you in a world of hurt.
Yeah. So the solution that we've had to go to sometimes, which nobody likes this solution, is saying, Mom, Dad, can we borrow $30,000 while it's transferred from stock? So what happens in that case?
Your parents get really mad.
Yeah. Some parents are cool about it. Mine wouldn't be. But some parents are like, really cool about it.
Really? You need $30K?
Yeah.
But so what happens in that case is it just, in essence, muddies the water, right? So what would happen is a couple things could work out here is that we prove that an acceptable party, relatives, gave you the money, and then that you had the money to cover it, you've repaid the relatives, and we washed the relatives out of the asset equation. Otherwise, we'd have to keep the money there and then go through gift funds, which isn't an acceptable source of funds, but it creates documentation that we have to then document the relationship between the giftor and the giftee, and go down that rabbit hole.
That relationship thing, that's kind of a big deal, isn't it?
It's a huge deal. It's a do or die deal. Right.
Okay,
so it's not Darcy, you and I, we've known each other for years and years and years. Mm-hmm. I cannot gift you money for a purchase.
What?
Not an acceptable relationship in the wide world of mortgage.
No. Friends don't work. So, colleagues don't work.
Friends, colleagues don't work. It's familial relationship status.
How close family?
Immediate aunts, uncles, cousins.
Okay.
It doesn't necessarily have to be immediate. I've gone as loose as cousins. So
perfect.
Yeah, but it does have to be a familial nature.
Yeah, and when that is gift funds, like you have to have the other person sign something saying we're gifting this money to them.
We're gifting this money, and this money does not have to be repaid.
Yeah.
And then you actually have to show the giftor has the ability to send the giftee the money either through a wire transfer receipt, a bank statement, or some other documentation. Yeah.
Okay. So let's get really fun. Cryptocurrency is a really big thing right now. And some people are getting massively rich off of crypto right now.
Yep.
So when somebody comes over and says, Keith, I want to buy a house, I just hit the lottery with crypto. I'm cashing it out. Give me
I'm looking for my button with the red X on it. Yeah, that's not going to work, folks.
Yeah, what's the ruling
crypto,
there?
So crypto is not an acceptable source of down payment. It's unless you're doing 100% purchase with crypto, which you totally could knock yourself out, make it happen. It's not an acceptable source to Fannie, Freddie, FHA, VA, and the gambit of jumbo mortgage outlets, right? And we're sitting here in November of 2021. Maybe if you're watching this down the future in 2025 or what have you, the environment has changed. But right now, crypto is not an acceptable source. So what you'd have to do is liquidate the cryptocurrency, put it into your bank account, and let it season for 60 days.
Right. So the way that I look at it is the government doesn't seem to think money laundering happens if it is in your bank account for more than 60 days. But that's my terms, not the government terms.
We got to draw the line in the sand somewhere.
You do.
Right. So that Fannie, Freddie, and the underwriters have said, hey, if it's been in a bank account for 60 days, it's sourced and seasoned, we're good with it. Right. That's what you have to do.
Now, Keith did mention if you're buying the house outright with crypto, like cash it out, it's in your bank account, you can just go ahead and buy it. While that might be true, do know that in the title documents, there is a sneaky little line now that says anything that's paid with cash has to be reported to the government. So the government's going to see that you bought that with cash, and the government is going to check up on that.
Well, but let's take that one step further. That's always been the case. They're just now telling people.
I will 100% agree, but it's been in there for
Right.
I want to say 2 years or so now. It hasn't been that long. I'm sure they've
any
always done
transaction that involves more than $10,000 worth of cash,
They're checking.
Has to be recorded. So that's what happens.
Okay, so this one I've run into before. Money in a safety deposit box or money under a mattress.
Yeah, the good old safety deposit box or gun safe or mattress money.
I mean, great for you to put money aside. That's awesome.
Yeah, it's great to put money aside and have a rainy day fund. And for those of you that don't trust the bank system, I get it. I understand. Again, it's got to be put into a bank account and seasoned for 60 days before it becomes eligible source of down payment.
Yeah.
Yeah.
Frankly, the government sees source being safety deposit box, but naturally their head probably goes to it's drug money or, whether it's true or not.
Well, it's funny. The origination of all this, or I'll say the extensive oversight of this is actually coming from 9/11. It's so part of the Patriot Act. And so that's where all these rules and regulations came into place. Getting into the world of mortgage in 99, like we didn't care. We didn't care where the money came from. Oh, you need a down payment for $50,000 and you walk up to the teller line and you put $50,000 in your bank account. Great. Let's close the loan. Right. And off we went.
Right.
So now, it's all regulations stem from 9/11.
Yeah.
Sorry, I geeked out. I'm sorry.
That's completely cool. It's true. It's true. And then it changed again after 2008 when they needed a lot more proof,
Yeah. Well, yes, that did happen as well.
You're right. So a bunch of changes. So what we're saying here is the source of funds is also a big deal. So don't just think, oh, I got this money, no problem. We're going to be asking questions about where it comes from. We don't actually care. We just want to make sure you're able to close on the house that you want to buy.
Right. Exactly.
That's the big thing.
There's one that's not on our list that I wanted to bring up that I thought about. Ooh. Selling stuff. People sell stuff.
They
to
do.
Raise money.
I had a client sell his motorcycle recently.
Motorcycles, boats, RVs.
Yeah.
I had a gal that I helped out in Montana. She sold tractors and augers and post hole pounders. Yeah.
Jewelry.
So it was a great way to do it. We have to be able to track that it's a tangible thing.
Yep.
Right. And then it has a book value of some way, shape, or form that we can go out to the market and see that these things are trading. Right. Tractors, pretty easy. You can go up to Facebook Marketplace. You can go to Craigslist and say, oh, yeah, John Deere tractor is trading for X amount of dollars. That's about how much they sold it from. Get a bill of sale, put the money into the bank account. That's cool. Cars, motorcycles, all good.
But it has to be somewhat realistic. Okay.
It does. Yeah, exactly. You can't go sell a motorcycle. Let's say the market value for motorcycles are $5,000 and you sell it to your friend, right, for $50,000.
It's not going to fly.
We'll give you $5,000 for it.
Yeah.
So.
Yeah.
Yep.
So you kind of have to be realistic, unfortunately. Sorry.
Unfortunately.
That's how it is.
Oh, yeah.
Keith, you ready for a Mythbuster?
Ooh, what? Are we there already?
I think so.
Yes. That's what all my equipment up here is for. Are we going to need headphones?
Well, I already have headphones on.
I don't have headphones on. See, I'm going to leave them right here because if I put them on, I can't hear you.
Yeah, that's fine.
So I'm just going to go like this. Hey.
I'm not putting the glasses on.
Why am I the only one getting my protective goggles on? Where are yours?
Anyways, moving on.
This is what happens when I'm not in studio.
Yeah, sorry.
This is Darcy. These would look good on you.
I'm sure they would. I'm sure,
Yeah.
I want you to be highlighted this time, You take it, the glory. Go for it.
So here we go. Mythbusters.
Yeah.
When I buy a house, all I need is my down payment money. That's it.
That's all the cash you need.
All the cash I need. When I go buy that $500, $700 million house, all I need is my down payment and I'm off and running. Boom.
Yeah. A lot of people think this. A lot of people are like, I have $500,000. I'm going to go buy a $500,000 house. Or I have, 5% of $500,000. I'm going to go
I got 5%. I got $25K.
Yeah.
I can go buy a house.
Nope. No, it's important that we mention to everybody that there are some other costs that you will have to bring money to the closing table for.
Absolutely.
Okay.
So I like to, people get stuck in this down payment bubble.
Yeah.
And I like to redefine it. Your funds or your cash to close. That's all encompassing.
Right. So that cash to close, first of all, that earnest money.
Yep.
That goes towards the purchase price. Okay. So that's less money that you have to bring to the closing table because you've already paid that.
That's an important thing to circle back on because we talked about earnest money through the whole top of the show, right? So that earnest money, though you may have released it early and escrow's not holding on to it or anything like that, it gets applied towards your total funds to close.
Exactly. Right. A lot of people think it's above and beyond. Nope.
Yeah.
It goes towards the funds that you have to close.
That's my favorite caller email. People are like, Keith, I think I'm maybe in a situation. I'm like, what? What's going on? Like, well, since I cut that check for $20,000, I'm now $20,000 short. I'm like, no, the earnest money goes towards your down payment. Oh my gosh, really?
You're
sweet.
Good.
Okay, let's move forward with ordering the appraisal.
But there are a lot of other things that we need to consider that do cost money on top of the purchase price.
Yes.
Okay. So on the loan side, there's a bunch of things. What do those look like, Keith?
So I like to break this whole transaction up into two things. There's stuff that you're going to need before your closing date and stuff you're going to need at your closing date, right? Yeah. So the before closing date stuff is the aforementioned earnest money. And then you're going to have to pay for the appraisal up front, right? So appraisal costs are anywhere between $700 and $1,000 right now. Thank you, the work shortage in the wide world of appraisals, that they've gone up substantially. We're closer to $1,000 per appraisal than we are $700. Just full disclosure.
I've seen as high as $1,800.
That is the one lender cost that you have out of pocket before your closing date.
Right.
Other things that you have out of pocket before your closing date are any inspections you want to do to the house.
Exactly. Right? If you're having inspections, it could be a basic house inspection. You might be hiring a roofer to come out and do a special inspection, or a chimney specialist, or a sewer scope. Or
concrete guy?
There's so many different inspections that you could possibly have. Those are coming out of the buyer's pocket right away, with the exception in this area of a septic inspection. Septic inspections are traditionally paid for by the seller.
Nice.
It's a little, little something.
So those things, so when you think about those inspections, what's the going price today on that side of the coin?
So it really depends on what you're buying.
Okay.
Condo is going to be a little bit cheaper. Smaller house is going to be cheaper. I'd say most home inspections these days for the average size house are between $500 and $650.
Okay.
If you're getting a sewer scope done, they can run $200 to $450. And those are the main ones around here that we have done most frequently.
So that's the stuff up front, right?
Yeah.
So you get under contract and all of these things are coming out of your bank account within the first week of the transaction.
Right. And actually, sometimes those are actually done before you even put the offer in on the house. Because that's how our market in the greater Seattle area is working. you might be paying for inspections before getting the house, and you might have to pay for a lot of them.
Wow. I just thought about pre-appraising a house. We don't do that right now.
They do that in some states.
Yeah, pre-appraising. That'd be interesting.
That's another conversation.
Yeah, that's another conversation. But so you've got earnest money, you've got your inspections for the condition of the property, and then you have the appraisal. And then once you get through that gambit, nothing's due until the actual closing date.
And I want to define that a little bit more. We say closing date. It kind of depends how you're bringing that money to the table.
Yeah.
If you're wiring it, it's closing date that morning, first thing in the morning. If you're bringing a cashier's check, it's the day before. You're not writing personal checks for this.
And they will not take a personal check. Yeah, no personal checks at the closing table. So then at the closing table, you have all the rest of the closing costs.
Right.
That's where the mortgage, the rest of the costs in the mortgage come into play. And what we're looking at there at those fees are underwriting your file, processing your file, title and escrow. So we're going to pull a title commitment on the house and make sure that there's no liens on the property or no weird easements like, oh, hey, there's an easement for a high tension power line to come through your property in 2 years. So we're going to do that. That's all going to be rolled up into your total funds to close.
Yeah.
Other things that are involved. And this is where it gets kind of weird because there's 2 boxes of funds to close. There's the mortgage closing costs, and then there's the prepaid finance charges, right?
The prepaids a lot of people get confused about.
Yeah, I was referring to the prepaid finance charges, right? So these things that underwriting, processing, title, escrow, appraisal costs, those things are lender-specific, transaction-specific costs.
Yep.
The thing that gets really confusing is then people see, oh, hey, okay, I've got $4,000 to $7,000 over here, depending on your purchase price, right? $4,000 worth of lender costs between title, escrow, and all that good stuff. And then I have another $2,000, $3,000, $4,000 over here in what are called prepaid finance charges. So that is homeowners insurance, prepaid interest on your mortgage for the month that you close, and property taxes, right? So we collect at the closing table somewhere between 3 to 7 months worth of property taxes, depending on where we are in the billing cycle for property taxes. And then we also collect the whole year worth of homeowners insurance premium, right? So if your homeowners insurance is $1,000 a year, we're going to collect $1,000 at the closing table. And then as you are paying your mortgage going forward from that point, if you have your homeowners insurance and your taxes included in your mortgage payment, we're collecting on a monthly basis the small little chunks that at the end of the year, when we get to the next renewal cycle, the mortgage servicer is sending the bill out on your behalf to your insurance company,
right,
and then to the county to pay for your property taxes. So we got lender's costs, $4,000 to $7,000, and then you have your prepaid finance charges, another $2,000 to $6,000 to $7,000, depending on how big your insurance obligation is and how big your tax obligation is. So when people then put these 2 numbers together, and it ranges somewhere between on the low end $7,000 and on the high end, I've done $14,000, $15,000 worth of total funds to close on top of your down payment. People are like, whoa, that's so expensive. Just keep in mind, you got to know those numbers going into it. Because we don't want any surprises.
And there's things like government recording and transfer fees, and there's things like that you have no control over. It's going to be charged to you no matter what agent you're with, no matter what lender you're with, no matter what escrow you're with. It's just how it is. So make sure you're asking about those numbers beforehand.
Yeah, it's super important to ask those numbers. And when you're out there shopping, understand what the lender is telling you in their quotes. Because so often I'll see folks, especially when you put down 20% or more, you don't have to have the taxes and insurance collected at the closing table, right? It's your option.
Right.
So I've seen companies before, to look better, they won't quote title in it. They won't quote homeowners insurance and taxes. So they look a lot cheaper.
They do.
But then they call you up and say, oh yeah, Mr. and Mrs. Smith, you want to include your taxes and your insurance and your monthly mortgage payment? And you say yes. And then all of a sudden your closing numbers change.
Right.
So
Exactly.
make sure that you understand what you're comparing when you're out there shopping for a lender. Super important.
So let's go ahead and put some examples to this, okay?
Okay.
Our first house, I'm going to go ahead and give you this house sold this year in 2021 for $795,000.
Nice.
Okay. By the way, I'm not actually using real numbers for a lot of these things because
the actual sales price have been changed for the privacy
of the
purposes.
Okay, but $795. Keith, how much do you think the buyer had to pay total out of pocket for this house?
$795.
Yeah.
Well, if we take our range, they're gonna add somewhere between $7,000 and $10,000 worth of closing costs.
Okay.
So let's call it. You said $795 or $799?
$795.
$795. Let's go with an extra $9,000.
Okay.
For closing costs. So they're now at $804.
Super close. This one they had to bring $802,960 to the table.
Gotcha.
So,
they must have cheap insurance.
Yeah, probably. So it was about $8,000 over the final contract price is what they had to bring to the table. Okay. We're going to do two more of these. The next one was closed for $890,000.
Okay.
Yeah, that was a cool house. I liked that house. All right, what do you think it sold? What do you think they had to bring to the table?
$898.
They actually had to bring $902,164.
Can I ask if there was an interest rate buy down?
I believe they did buy points, and this is why I chose this one. So
they bought points.
Yeah. So that is an extra cost. Keith, what does it mean when somebody buys points?
See, we didn't even rehearse this. I was like, did they buy points? They bought points. I know they bought points. So when you buy points, you're basically prepaying the interest to get a lower interest rate over the life of the loan. And points are very beneficial in certain cases. I don't this is like falling off. I'm going to take this off now.
You're not protected.
I don't necessarily always prescribe and advise points. Points are very finite, right? So in this case, you were at 890.
Yeah.
Yeah. So I could buy a discount point of 1%, right? So I can incur a cost of $8,900 and buy the point down, and I'd get a lower interest rate. So if market rates, for an example, were 3%, I can pay 1% upfront and get maybe 2.75 or maybe 2.625, right?
But is it worth it?
Is it worth it? That's always the question that I put back to my clients, right? The question, the number one question you should be asking when you're buying points is, how long am I going to have this mortgage?
Yeah. How long do you plan on living there? And be realistic, because everybody tells me, oh, I'm buying my forever house. And 3 years later, they're coming back and selling it and buying something else.
I hate that piece of crap.
Be realistic. Well, it's life circumstances change, you know?
Yeah, exactly.
When you have little ones, you don't need the same house when you have, teenagers or when they leave the house. It can be different. Okay, we've got our third house up here, of course, in the Seattle area. This house sold for $1,090,000. I didn't realize all of these had a 90 at the end, but $1,090,000.
Okay.
I refer to this one as the purple and yellow ugly house.
That sounds like husky colors.
Okay, the people that bought this house, clearly it's a seller's market. What do you think that they actually paid for the house?
Points or no points? You got to give me that.
No points.
Let's go with 1.98.
1.0999. 7.6.
Nice.
You know, and different things, as we discussed before, can adjust those. But the point is, you're going to need extra money above and beyond the purchase price for closing costs. Super important.
Yeah. I say this, when you look at the closing costs and what that will all entail, if you're prepared to do 2% over the listing price in closing costs, that's generally always going to keep you in the ballpark unless you're getting really aggressive to buy down points.
Yeah.
But typically you're at 1%, but if you're prepared for 2%, you got lots of flexibility there.
It's the same thing on the sell side. We tell our clients, hey, be prepared to pay approximately 10% of the purchase price in fees to sell your house. Now, in that, there's a lot of things like excise tax and realtor fees, and so many different things are in that. 10% is a high estimate, but it's better to estimate high on those numbers than it is to estimate low.
Well, yeah, and the other thing too, it's kind of a sliding scale, right? 2% on $1.5 million purchase is a lot bigger number than 2% on a $300,000 purchase, right?
That is called percentages.
The lower you go, the lower your purchase price, the higher percentage of closing costs you're going to incur, because the cost for title and escrow are pretty flat. The cost for an appraisal is pretty flat, right? So you're going to pay that $900, $1,000 for that appraisal, regardless if it's a $300,000 townhouse or a $1.5 million waterfront.
Right.
You're going to still pay that same $1,000. So when you look at that, there is a little bit of disparity when you're on the lower end of the purchase pool than you are on the higher end.
Right. But things like property taxes and all that type of stuff, they're prorated, and those go along with the property tax. So you're paying a lot more on that side. So, it is different for every single house, and that's why we can't give you this is how it is, this is the formula, because every transaction is different. But we wanted to make sure that we gave you some different ways to look at the funds needed to buy a house.
Yeah, absolutely. And know your numbers, right? And Darcy, I say this all the time. There should be no surprises in income, assets, or credit once you've inked that purchase and sale. This is all great stuff we get to explore in the pre-approval process. And in that pre-approval process, you're going to have a really close number that you can feel good about in making that escalation clause from $600,000 to $700,000, knowing what those estimated closing costs are going to be.
Yeah. Although if it does take you a long time to buy, you need to update that because rates change, and you cannot ink the rate. You can't lock that until you're in contract. Oh yeah.
Rates as recent as August are completely different than today.
100% different.
So. Well,
all right. Well, that was a lot of information. I look forward to next month.
I don't know what those earmuffs did to my ear, but my ear is bright red now.
You're embarrassed.
Am I?
I'm looking forward to next month when we get to do this live again. And
yes,
I'm
live
really
in studio.
Yeah, I can't wait to get some audience participation.
Right, and we'll have some sort of holiday theme. We'll do some sort of theme party.
Sounds good to me.
Oh, I know what we can do. Darcy, this is a little tidbit you guys may or may not know. Darcy loves herself some hot chocolate.
I do love hot chocolate.
So maybe we'll do some hot chocolate and marshmallows. Well, we have our show next month.
I'm in. I'm completely in.
We'll see you guys next month. Thank you for tuning in. And as always, like, share, subscribe, ask any and all the questions that you have. And we look forward to seeing you guys next month.
And have an amazing Turkey Day.
Oh, yeah, that too. Happy Thanksgiving.